Okay, can we start? Okay, yeah. Today is just as a bonus. Okay, I come early, then I leave early as well. So I will leave 10 minutes before normal time, or maybe 4:30. Yeah, it's okay, right? Okay, we still discuss about tax on incomes. Yeah, we almost come to an end because actually we have we're talking about the lesson we have to learn about around six sessions, and now we up to fifth sessions, which we discuss about comprehensive tax calculations. Yeah. So in order to calculate tax on incomes, what we should do first is that we need to, what is it, write backs and deduction of non-deductible expenses, taxable income not recorded in accountings, books, expenses not recorded, but deductible in natures, and income recorded but not taxable. So we have to identify what we need to add backs, which means we need to think about non-deductible expenses. Next, taxable income not recorded. Some taxable income, but from a tax perspective, this income subject to tax. But accountings are not required to record in the P&L accounts. Yeah, they have to add it back as well. From accountings, not considered as income. For example, unearned revenues, right? Unearned revenue, which means we get a payment first. And from accountings, you record as liabilities, not as an income in the profit and loss accounts. But unearned revenue is taxable income in natures. So we have to add it back. Expense not recorded, but deductible in nature. Yeah, okay. We have to also take into account which expense is not recorded, but you can claim as deduction. One of the commons we have is that tax depreciations. Because tax depreciation, we are not going to depreciate this in an accounting's financial statement. We have to calculate separately, and then we can claim a deduction based on tax. So what happened with the accounting depreciation then? What happens? If you can claim deduction only tax depreciation, but what happened with the accountings? What we need to do? Yeah. Okay, we can claim a tax deduction, a tax depreciation as a tax deduction. How about accounting depreciation, which we record in the P&L? What we have to add it back? Yes, correct. So this is a non-deductible expense under the tax on income. And then we calculate step 2. That's the first step, first part. Yeah. And step 2, we need to calculate the maximum deductible charitable contribution for the years, then add back portion of non-deductible charitable contribution. Yeah. Then we need to do another calculation, which is charitable contributions. Yeah, which we can claim deduction 5% of profit, exclude charitable contributions. Okay. And step 3, yeah, we calculate interest expense, maximum interest expense that allow to deduct again tax on income. Okay, if interest expense incurred during the year less than the maximums deductions, we can claim full during the year, no aid back. But if it is less than, then we need to aid back. And step 4, take into account of losses, loss from previous year. You know, after we calculate tax on income by including or make an adjustment with respect to the interest expenses, then we will get what we call taxable profit for the year. And then we have to look at the loss carry forward. If we have, then we claim deduction. If we don't have, yes, just not. Next, okay, we get the profit after, take into account the loss carry forward adjustments. Then you can have a profit for the years, taxable profit for the years. Then you calculate 20% rate. You apply 20% income tax on the profit for the years. Then you will get TOI liability. Okay, next step is step 6. Take into account foreign tax credit. Yeah, if you have foreign tax credit, because now you get the TOI liability for the years, then you have to, calculate the maximum foreign tax credit that you can claim as deductions. If you have, if you don't have, then just don't ignore it. Okay, the last one. Oh no, step 7, not last. Okay, identify the real TOI liabilities that you need to pay to the tax authority by comparing with the minimum tax at this time. So we identify what is our final liability we have for this year's. Okay, by comparing with the minimum tax. If you are not exempt, if you are exempt from minimum tax, then you don't need to compare. If you can identify, your TOI liability, okay, which we probably may be higher than minimum tax. But in our exam questions, we always subject to tax on income. So they always provide that the companies is the tax, can get the minimum tax exemptions. And then step 8, we need to take into account the final tax payable to the GDT by minus tax credit such as withholding tax credit, prepayment tax, prepayment tax on prepayment on of tax on profit. Then you will get whether you still have a balance or not. Yeah, you may have, if you have a positive balance, which means that is your actual tax payment to the GDT. But if you have a negative figure, which means you still have a credit, which means your tax liability is higher than the tax credit. So you still have credit to carry forward to offset with the TOI in the future. Okay, that's 8 steps we need to learn about how to calculate a tax on income. Okay, of course, to calculate, we have this is a spreadsheet. Yeah, you need to follow. So we start with take into account, we call accounting net profit or loss before tax. This should be before tax. It means before TOI. Okay. So this is where we get it from. We get it from profit and loss account. So accounting's profit or loss. If it is profit, which means it's positive. If it is a loss, yeah. If it loss, will be negative. Put negative figure here. And then add back on non-deductible expense. Yeah. Which we're talking about the step one that we have to take into account, all kinds of non-deductible expense. And then we add back all taxable income not recorded in the accounting book. So we will learn, this what kinds of non-deductible expense that we need to know. And then we also need to know what kinds of taxable incomes not recorded in accountings, but taxable under income tax law. And then we will learn about expenses not recorded but deductible in nature. I give you an example. At the moment, it is tax depreciations. This is tax depreciation, but there's still more. Then we last some income you record in the financial statement, but it's not taxable. Mostly unrealized income. Because only realized income is subject to tax on income. So all unrealized income is not subject to tax. But of course, from accounting perspective, from accounting rule, you are required to record whether realized or unrealized. Yeah. Okay. So accounting's treatment different from tax. So this is considered step one, which we discussed. And step two, we calculate the we have income or loss after adjustments. That's as we call income or loss after adjustments. Then we add back non-deductible charitable expenses. But this required to have a calculation, right? We have the calculations. So we need to calculate to find a maximum charitable contribution deduction and compare with the actual. If the actual minus maximum, we have a positive number, which means we add back. But if we take actual charitable minus maximums, and then we get negative, it means we can claim full deduction. So no adjustment, no add back. After that, we have another we call adjusted profit or loss before interest adjustments. And then we calculate interest expense, interest deductible interest expenses. Do you still remember what is the maximum interest expense, deductible interest expense? Interest, yeah, 50% of net non-interest income plus interest income. But if you have here maybe loss, so what is your maximum interest expense, deductible interest expense? What is your maximum interest deductible expense? Because you have loss. If loss, the 50% of net non-interest income will be zero. The maximum will equal to interest income. This is a long debate amongst the tax consultants when the company making loss. So what is the formula we need to do? And some will say, if you lost, you calculate, then you have a maximum loss that you can claim deduction, and then we have a negative numbers, and we will add with the interest income. Sometimes it turn into negative. So that is not the right formula. Okay. After whether we add backs or we claim more deductions, it depends on the the amounts of interest expense we incurred this year and probably from last year's. As you know, interest expense can be carried forward for how many years? 5 years. Okay. taxable income or loss. Log carry forward here. Can we carry forward for how many years? Interest can carry forward for 5 years. How about log carry forward? No, 2 is incorrect. So repeat, also not correct. Okay, keep increasing. Okay, 5 years. Okay, interest, 5 years, loss also 5 years. But don't forget condition to claim a loss carry forward is that no business change. You have to claim deduction. The early of the loss incur, and yeah, the loss must be recorded in the tax returns, something like that. Okay, so with less loss, then we can have what we call taxable income or loss for TOI calculation. Okay, and then I never said about lock river for 2 years. No, 5 years. We have 4 years. 4 years special depreciation, right? Yeah, and 2 years. Yeah, no. Okay, then we calculate tax on incomes, 20%. Okay, if you have foreign tax credit, we deduct, and we also, if we have, we call ADDT, advanced dividend distribution tax. We can deduct from the income tax liability, and then we will get income tax liability here, and then we compare with the minimum tax. Okay, how much is our minimum tax? If we're not exempt, then we have to compare. If we exempt, then we don't need to compare. We ignore the minimum tax calculations. Income tax higher, then we will record it here as the income tax liabilities. After that, we deduct withholding tax credit, we deduct prepayment of income tax, then we will get the final tax liability we need to pay to the GDT. Yeah, this is a format, during exam, they provide this format to you, Excel spreadsheet. Then you have to fill in, key in. Yeah. You input the data, the numbers into that spreadsheet. They actually have the formula, for you. But don't forget to test the formula. Sometimes the Excel spreadsheet is not really not properly function. Maybe provide an error. Okay, so this is a non-deductible expense that we have in the TOI returns. Okay, that you need to add back. First is accounting depreciation. So you have to add back accounting depreciation. First thing. Next one, this is if we prepare tax on income returns, all of this account already exists there. They recorded there. You just fill in the numbers. Next is amusements, recreation, and entertainment expense. We have learned about it. We know, right, what kinds of entertainments we need to add back. And donations, grants, and subsidy, which is not charitable contributions. So we also require to add back loss on disposal of asset per accounting books. Yeah, that's applied for asset class 2, class 2 to 4. So if asset class 1 and any asset that use straight line depreciation, when you dispose, you can calculate capital gain or loss. If you gains, you pay tax. If you lost, you can claim deduction. But if you dispose asset class 2 to 4, it means 2, 3, 4, you cannot calculate capital gains from tax perspective. Of course, accounting you will do, you will do because you can track each asset, each asset, how much the book value still remains and how much you can sell it. And then you can calculate capital gain or loss. And then probably if you record in the accounting, say loss and dispose of asset that is class 2, 3, or 4, this loss is not deductible for tax purpose. You have to add back. But asset class 1 and any kinds of asset can be tangible or intangible that use straight line method, then you can calculate capital gain. If gain, pay tax. If loss, you can claim deductions. Extravagant expenses, there's unnecessary expense. It seems it's too much from a tax perspective. Do we have any kind of like a limitations on that? No. Yeah. So when the GDT come to scrutinize on the extravagant expense, normally they will compare, if sometimes they compare with the government, maybe government rate, especially with the per diems or any business or traveling expenses. Or they would compare, probably let's say you pay for a hotel in Phnom Penh, the 4-star hotel probably $70, $200 a night, but you end up with paying to the 4-star hotel $150, for example. Then it means they say this is extravagant. The $50 excess from the normal market rate will be considered as extravagant. And the same story, this is a real story. I just met with one of the banks here in Cambodia. They have 2 loans. They're going to have 2 loans. Okay. They conclude the first loans in January this year. First loan. They signed in Jan 2024. Interest rate 5% per year. Okay, they will conclude second loan in October this year. But the interest rate is 12% per year. The same terms from the same, lender, increase from 5 to 12. Yeah. I asked him, he came to my office this morning asking whether he can claim deduction, claim an expense 12% or only 5%, because the first loan already conclude, say 5%, and from the same person, they provide another loans, which they're going to charge 12%. I asked him, is there any reason why you increase the loan? No. Same contract, the same terms, different date, different amounts, and different interest rate. Yeah. That is not an example. This is a real. Okay. So then from the tax department point of view, you say, what? Yeah. Term of the loan contract, the same lender, to conclude at the beginning of the year 5%, but at the end of the year 12%. It's mean unreasonable, say extravagant. So it means the different 12% per year is become a non-deductible expense. Yeah, you have to add back. 7. Yeah. So then you have to add back this loan, the interest on this loan by, adding back 7% of the second loan. Yeah. AD, advanced dividend distribution tax. It means the tax we pay on the dividend distribution that we distribute before pay income tax. So if you distribute the profits before you pay income tax, you are required to pay we call advanced dividend distribution tax. But this is tax credit. We will learn about it. Don't worry. Yeah. Yeah, yeah. They compare why they have to deduct foreign tax credit before before we compare the minimum tax. Why? Because the foreign tax credit is advanced tax, right? ADDT also advanced tax that we pay, and that's why we can deduct from a TOI liability before we compare with the minimum tax. Advanced prepaid. Yeah. We pay in advance, like advance payment or prepaid. Yeah. Yeah. You need to run through, you might need to run through all of this expense so that you can remember, what kind of expense I need to look for when you do a tax computations. Okay, non-business related expense. Okay. Yeah. Loss on related parties transaction. So if you have related party transactions and you buy and sell, mainly focusing on a immovable properties. Which means you sell and then it lost. I mean your selling price lower than the book value. Yeah, and then you generate loss. This loss is not deductible. But if you sell to third party and you make loss, you can claim as deductions. But if related party, no. Expense related to previous period, last year expenses, also not deductible. Other non-deductible tax expenses, which is maybe withholding tax that we pay on behalf, maybe tax penalties, and what else? Remuneration of the owner's families. Yeah. If the owner family doesn't come to work and we pay salary, yeah. Any funny story that you can share? Yeah. Okay. Benefit in kind of owners and families. Salary unpaid within 180 days. Yeah. And maybe some of the expense that is not on the list above, and you think that, oh, non-deductible, you can include it here. If this is a list provided by the tax department, in the tax return. If now you're picking up all the list, but there's some other expense that you analyze that, you cannot claim deductions, then you can include, in the last points. Maybe this include what we call remembers when we expense to related parties, which is not paid within 180 days, right? For purchase of service, royalty, yeah, maybe interest, for example, which is you cannot pay it within 180 days of the following years, then you need to add back. Yeah. add back here. Okay. Yeah. Please, read it. Yeah. When you do a tax computation, and then you oh, which one I have to add back, because in the tax return they provide all of this account, but in the exam question they don't provide. You need to write it and analyze by yourself. Okay. Sometimes you need to spend time typing. Okay. Oh yeah, accounting depreciations, entertainments, increase in, oh yeah, increase in provisions. It means if you make a provision for account receivable, provision for inventory, or provision for any loss that you think it's lost. Yeah. If you make provision that year, it means you need to add back. Okay, this is point A that you need to include. This is all kinds of non-deductible expense record in the books, but it's cannot claim as deduction from the tax perspective. And then you come to section B. You also need to add backs. First of all, they said taxable incomes but not recorded in accounting books. Yeah. You need to pay tax, but accountants do not allow you to record in the profit and loss account. Let's say supply of good or service free of charge. Yeah, when you provide something to someone free of charge, it means you are not required to record as income because there is no invoice issue. But from tax perspective, nothing for free. Okay, you can offer free, but you pay tax. Yeah. Okay. Granting fixed asset to use for free of charge. Okay, you have a fixed asset, and then you provide a free somebody to use it and free of charge. Also required to declare as a taxable income based on a market rate. Improvements of fixed asset made by lessee without charge to the lessor, which means you are a lessor. You have a fixed asset, you lease to someone, and the lessee, the one who leases asset from you, they make an improvement, like a permanent improvement that can increase the value of that asset. Then you also need to record this increment as a taxable income. You pay tax. Okay. Donation or grant and subsidy not recorded. Sometimes you get, they donate something to you, maybe asset or maybe money. Okay, but you don't record as income. No, somehow you don't record. Of course, all kinds of something you receive from someone else, it is the taxable income. Gain on loss of fixed asset as per LNT, which means when you dispose asset, and under the law on taxation allow you to calculate capital gains. Yeah, from a tax perspective, because maybe from accounting you're making loss, but from tax you gains, right? Because based on the depreciation rate, maybe accounting lower than tax rate, and of course if tax rate higher, the book value will be lower. And when you sell it, accounting, sometimes you calculate, you see loss, but from tax, based on tax law, you calculate and then you make a gain. Of course, we need to add back. Other income not recorded in accounting books. Yeah. Probably unearned revenues, that we have to add back. Plus 2, 3, and 4. If you dispose one asset in the pool, let's say you can have like a chair, 1,000 chair, but you dispose only 100. You dispose some part of it. You not dispose a pool, then you cannot calculate capital gain or loss for asset class 2 and 3. So if Gain, no tax. Loss, non-deductible. But for asset class 1 or any assets depreciate based on straight line from the law on taxation, you allowed to calculate capital gain and a loss even you dispose only one asset. Yeah. Yeah. Okay. This is probably, I say class one asset plus uh, other asset that use straight line method. Recorded in the accountings. Yeah, per accounting you add back, and then if you calculate per tax, if you see loss, you can claim deductions here. If you see it gains, then you add back. Accounting, loss or gain, you have to add back on the because as I said, the depreciation rate from accounting and tax normally is different. Why I say different? Because tax, first thing is, even though you try to set a rate the same, let's say 5% the same, but when asset put into use from accounting, you depreciate based on the numbers of months that you actually use. But from tax perspective, even though you use for 1 month for that years, you can claim full deduction for whole years, and that you can see the difference already. Okay. This is something we need to add back, so incomes and the section B, and then we go down to C. This is example of expense not recorded but deductible in nature. Yeah, we have some expense we are not recorded in the profit and loss account but can be deductible. First of all, deductible amortization or depreciations expenses per LOT, per law on taxations. So you have to analyze on asset you own, and then separate it into class 1, 2, 3, 4. Okay, and then you start doing calculations of that asset by using the tax depreciations rate and method. Okay, then about the special depreciation for QIP, some they choose to do a special depreciations. Yeah, we can put it here. Decrease in provision. Last year we make a provision, but this year we say, oh, we don't have provision. So and then the provision is increased, which means, oh, we anticipate that the loss that we say that we record last year, it seems now the loss is no more loss. The client pay our bill. Okay, client pay our bill. Then you make an adjustment in accounting by adjusting to the provision accounts. And loss on disposal of asset per law on taxation. Yeah, if under the law, if you dispose of that asset, and then we can calculate based on law on taxation. If it incur loss, we can claim deduction here. And other non-deductible expenses. Sorry, other deductible expense. Yeah. Okay, this is we add back all non-deductible expense. We add back income is not recorded in the accounting books, and see we claim deduction. This is we deduct, or we say less here. The 2, the A and B is 8. Yeah, 8 here. Okay. And section D, they said this is V less. What they said, example of income recorded but not taxable. Some income you record in the accountings, profit and loss account, but It's not taxable from a tax perspective. Okay. So the income that is not record from, first one is said dividend income. Dividend income received from resident taxpayers, But if we receive dividend income from non-resident taxpayer, it's taxable. But if you receive from a resident taxpayer, it is exempted from income tax. And gain on disposal of assets as per accounting books. Yeah, which is, I believe, can be asset class 2 and 3 mostly. Class 1. Sometime if gain per accounting, you also need to add back. Maybe other incomes not recorded. This is maybe some unrealized gains. Yeah, unrealized gain. For example, unrealized exchange gains, maybe revaluation of asset or something like that. Okay. Yeah, this is the part step 1 which we discussed. We add backs all non-deductible expense, we add backs income not record, we claim deduction expense not record but deductible, and we less or deducts the incomes recorded but not taxable. And then we arrive at we call adjusted. Huh? Yeah, I mean, based on accounting, you calculate, right, when you dispose asset. By using accounting book value, yeah, you take proceed minus book value. If it gain, sometimes it gain. Yeah, it gain, it mean this is not taxable. But from in your account, profit and loss, you have to record the gains is as your income, other income. But it's, yeah, can class 2, 3, and 4. I think class 1 probably maybe also include, because if it's create if the book value accountings and tax is not the same. Yeah, yeah. So I would say here, I mean, okay, all of asset, all of FA. If it gain per accountings, then you need to add, claim as deduction. So it's not taxable. Okay. So if you do all of this, then you will arrive at what we call adjusted profit before charitable contribution here. We are at this stage, which means we complete step 1, calculation. Yeah. And then next step is that we need to do a charitable contributions workings, so that uh, we know whether we need to add backs or we need to adjust it. If the class 1 and other straight line method have a different what we call a book value compared to tax book value, then we also need to add back. Yeah, let's take note on that. Yeah. So yeah, we learn how to calculate, just learn the principle, the steps that we need to do. And the big part going to be step one, which need to identify. This is the most headache one, when you're trying to identify each accounts, whether it's deductible or not deductible. Yeah. But based on the exam question, if you can identify one of these account, whether deductible or non-deductible, and you can write it, you get 0.5. 0.5. So okay. Don't worry, we will learn about how we can do the okay, next. Yeah, we're talking about yeah, this is old names, but they changed the name. We call advanced tax. This is changed to advanced tax, which we discussed about ADDT. Advanced dividend distribution tax. Yeah, this is how you calculate advanced dividend distribution tax. So if you distribute dividends after you pay tax on income, 20% or 30%, then this ADDT not apply. It doesn't matter you distribute to who, residents or non-resident taxpayers. Sorry, shareholder. Yeah. So if you distribute dividend, out of the profit that you already pay tax on income, 20% or 30%, then no ADDT. But if you distribute the profit before TUI's payment, you are required to pay ADDT. This is the formula. Okay. For example, if you maybe you distribute like based on mid-year profit, mid-year profit. After 6 months, you finalize your financial statement and you see the profit, a lot of profit. If you show this to the shareholder, you make a lot of profit, the company make a lot of profit in mid-year, all shareholder will want, hey, I want some profit. Why don't keep too much in the company? So I want, that's they want money. Okay. Let's say you distribute here the profit before paying tax, then maybe $1 million. So how much ADDT you need to pay? ADDT equal to 1 million divided by 0.8 and then multiply by 20%. So 20% is the income tax rate, right? They just assume what you distribute or pay to the shareholder is the amount after tax. Whatever you pay, the amount you pay to the shareholder is amount after income tax. Yep. Okay. Then to calculate A, they divide it by 0.8. Why divide it by 0.8? Because income tax calculation, we calculate by take the amount before tax deductions. Before the tax deduction. Remember the withholding tax we discussed? So the amounts that the person receive is the amount after tax. Why 2.8, 0.8? Because this is this amount that we pay equal to 80%. Yeah. So the income tax base should be based on 100% income, which means income before deduct tax. So how much is the income, gross income? Sorry, 2.5, right? And multiply by 20%. Like this, or it's correct? Okay, and then we multiply by 20%. How much we're going to pay? Yeah, but this is a credit, right? Credit that we can deduct from a TOI liabilities, based on our based on our law that I just explained to you, right? We calculate 20%, we deduct foreign tax credit, we deduct ADDT, and then we compare with the minimum tax. Okay. We just pay because we pay this to the GDT. Yeah. We pay at the times when we distribute a dividend to a shareholder. Okay. Let's assume we pay to the non-resident shareholder. What kinds of tax implication we need to take into account in this case? If we pay to non-resident. Yeah. What kinds of any other tax implication that we need to take into account besides a DDT? My first question. If we pay to non-resident, is there any other tax implication besides ADT? Okay, withholding tax. Yeah. 14%. On which on which number? $1 million or 1.25 millions? Okay. Apanya? 14% on 1 million or 1.25? 1.25 is your answer. Okay. Yes or no? Yes. Okay. How about David? Okay, you just follow Panya. How about David here? Second David. Because we apply withholding tax on dividend distributions. Yeah. So, same as him. Okay. Yeah, that's very interesting because you see, withholding tax 14%, you should pay, but you have a difficulty to figure out what the tax base you would use in this case. Press May. Huh? Yeah. Yeah, 1 million or 1.25 millions. How much the shareholder receive? Yeah, he received 1 million. Yes, based on example, right? Company pay him $1 million. So he received 1 million. Okay. Then based on our withholding tax law, so we need to calculate based on the income he receives, based on the current rule, which means whatever he receives, then this is the tax base. It's just 1 million, not. So we have to pay another tax. Yeah, because 1.25 is a income before, before a TOI's liability, because we distribute a dividend is from retained earnings after tax, right? We distribute dividend, that's we call dividend. Okay, that's the rule. Okay, and yeah, he already received 1 million, which is this is the income that he get. Okay, you can see at the time the company make a payment of dividend before tax, $1 million, you need to pay a lot of tax, 225,000 income tax, or we call ADDT, and another 140,000 as a withholding tax if he pay to the non-resident. How about if we pay dividend to resident? Only ADDT. So residents shareholder are exempted from withholding tax. It doesn't matter the shareholder is a legal entity or a physical person, registered or non-registered, but can be foreign residents, and the tax also exempted. Okay, this is a tax related to dividend, can be ADT plus withholding tax. Yeah, it's changing a little bit. For TOI purpose, a person who receives dividend and can show the proof of payment for ADT by ways of notifications as required in a tax form shall not include this dividend in his taxable income. As I said, I mean, if the shareholder is a legal entity, they need to show the evidence that, this is dividend received from the residence subsidiary, and the proof is that you need to show some sort of a notification to the tax department that, yeah. Okay, next one, we learn how to calculate capital gain based on tax law. Yeah, we know how to calculate based on accounting, right? I believe that you know, but tax law, they also have a rule on how to calculate capital gains. So because capital gain, if we use tax law to calculate, if we gain, we pay tax. If we lost, we can claim as deductions. So the general rule is that capital gain or loss is different between real value of assets and its net book value. I see maybe not different from accountings. Yeah, I mean real value. Yeah, probably the transaction value or the proceeds from sale of that fixed asset compared to the net book value. But from accounting, sometimes you have to take into account the residual value. But for tax, we don't have residual value. We only have tax book value. Yeah, they said there are two types of capital gain under tax law, or capital loss. Which, first of all, realized capital gain or loss. These values arise through disposal of asset. Okay, this disposal is an intention of acts of the owner or managers of the enterprise. Okay, when we actually dispose it, and then we can calculate based on tax law, and we see it gains or loss, then this is we call realized capital gains. And if it's if it gain, it's subject to tax, and if it is lost, we claim as deductions. Another one is recorded capital gains. This is what I would say that we call unrealized capital gains. Yeah. What happened with the unrealized capital gains? Okay. This value arise through recording in accounting books of the current value of assets in replacement of the old value. This is a revaluation, right? Revaluation of an asset. which based on accounting rule, you are required to record a net present value. Okay. But it said here, if that record arrive from the unauthorized revaluation, you should pay tax. But as I said before, there's no like competent authority or any government body here responsible to approve when you want to do revaluations. Maybe sometimes if for a immovable property, you do through the real estate agents. That's a licensed real estate agent. It's work, but some of the immovable property, such as machinery, equipment, sometimes government actually not control. But of course, if you require under accountings, and then you properly appoint, the proper valuator, it's also possible. I would say that is the valuation performed by authorized revaluations valuator. But of course, if you do revaluation or by using a authorized valuators, such unrealized capital gain is not taxable, so you are not required to pay tax. Yeah, but the capital may be recorded if it is loss, realized capital loss. So the loss is not allowed, for tax deduction. You can just record, but not allowed. Gains you are exempt from tax, but loss also not allowed. Yeah. Okay. This is a rule. But from accountings, if you do revaluations, if it gain, you record as other income, and it loss, you record as an expense. So, but from tax perspective, I'm not taxable if it gain and not deductible when it lost. I repeat here, realized capital gain or loss will be taxed or deducted. Again, tax on income. Yeah, we discussed earlier on that there's special case. If we sell or exchange properties, which mean immovable properties mainly, between related parties, the property directly or indirectly between related party is non-deductible. If we sell or exchange and we record loss on that disposal, the loss is not deductible from tax perspective. Yeah. Even though you are hire a proper valuator to do a proper valuation, saying this is a market price, or sometimes you have a quotation. Some company will do, okay, just valuator alone maybe not enough. Some company will do auction. You do auction, and then you invite a lot of people come to do a bidding, and then you see, okay, from a third party perspective, this is a price that you can sell this asset, and then you use that market price, I would say that's a market price because this is the offer from an unrelated party. But if such price still create a loss, still non-deductible. Okay. From tax perspective, that's a special case, special rule. So you need to be careful when you have this kind of transaction. Okay, then we'll learn about deductible tax and non-deductible tax. Tax can be deducted from tax on incomes. We have patent tax, we pay on annual basis, custom duty, 1, 2, 3 specific tax, and non-deductible, or we say non-creditable VAT input. Yeah. Yeah, which means when we purchase, we have VAT inputs on the purchase, but we cannot claim credit. For example, we late or not proper invoice, or some purchase is not allowed for a credit, then we can record this as a tax expense. For transfer tax or stamp duty, stamp tax, stamp tax, maybe you can see, you on the bottle of wine, whiskey, cigarette, that's a stamp. You can see the sticker that we call stamp tax. But that this tax is only only applied to alcoholic drinks and cigarette. So you can see that when you buy a legal products properly import, then you can have a stamp on that, maybe a cigarette box or a bottle. And tax on transportation, you pay for they call road tax. Sometimes they call road tax, or tax on transportation means. Yeah, the official name, tax on transportation means. But many will say road tax, right? That's from Cambodian word. Cambodian word say pun plau. Okay, then translate into English, road tax. But the official name, tax on transportation means. Yeah, motorbikes. If the engines not more than 125 cc, you are exempt from this road tax. But if your engine more than 125 cc, you need to pay road tax. Okay, the tax collect through withholding systems is non-deductible. For example, tax on salary, withholding tax, fringe benefit tax. Yeah, FBT. So this kind of tax is we call tax on we collect through withholdings. This is a kind of income tax or direct tax. So if we incur the expense related to these three type of tax, you are not allowed to claim as a deduction. You have to add back when you do a income tax calculations. Yeah, TOS here, salary tax, right? TOS. Output what is not your tax. Output is mean you collect from a customer. It's not your tax. Yeah, this is not our tax, and that's why if you pay on behalf of the person who receive income, consider as a non-deductible expense. Sometimes they don't allow us to deduct from their income. Yeah. Yeah. The output what is supposed to be the tax that you collect from the customers. But sometimes if you cannot collect, that's your fault. Sometimes you provide free of good, right? Free of goods to someone that you cannot collect. But you end up with paying, output tax. But the tax that you pay through output tax, you actually offset with your input tax in that year. You can see that. So you never have a output tax record as a tax expense. No. Okay. No, this is a non-deductible tax. Okay. Okay. So discuss on the last point, and on Thursday we will, do to do a real TOI calculations. I will use the maybe past year exam questions, to work with you. Okay. Last one. Capital versus debt financings. I think you already know, right? Capital financing is a capital contributions, whether in cash or in kind, is not taxable. So if you contribute as a capital, as equities, yeah, in the company, whether in cash or in kinds, you are not subject to tax on income. Yeah. And if you contribute into the company as a debt financing, you provide a loan. Yeah. A loan will incur interest, which will interest expense be deductible to limitations. Yeah. I mean, to fund a company, you can do two-way capital contribution. But you can put in cash or in kind. So it's not taxable. Yeah, the company actually receive money or asset from the shareholder, but that's not taxable. Or you don't want to put into a capital, maybe you choose debt financing. So debt financing is, yeah, sometimes it's good, sometimes it's bad. It's a type of sometimes you have to do a tax plannings before you decide whether you contribute as a capital or contribute as a financings. So I think we're going to learn about it because we have a session we call tax plannings that we're talking about. We're using base erosions method, which means try to increase expense as much as it can. To increase expense, yeah, debt financing is the option, because if you lending out the money to your companies, to your subsidiary, yeah, you can charge interest. The company can record the interest expense, but of course, then we have to think about the limitation. How many percent you need to charge? Based on my example, the company charge, based on example, some 5% or 12%. I think maybe they want to charge 12% because they see that the company making a huge profit this year. I don't know. That's why they try to pump up the expense so that you can reduce tax on income. But based on what they're going to do, it is not a proper tax planning, because they are not using the same rate. I mean, they will lose some part of expense as a non-deductible expense. Debt financing, the loans, the principal of the loan is non-taxable. Yeah, non-taxable. But the interest expense that your subsidiary pay to you can record as an expense, but it's subject to what kinds of tax? If you are not bank or microfinance, will subject to withholding tax, right? Yeah. But if you contribute as a capital, there's no any tax implication at all. No income tax, no withholding tax. But if you contribute as a debt financing, interest expense will incur. And then the question is withholding tax implications. But sometimes withholding tax implication can be good or can be bad. As I said, it depends on the performance of the companies. If the company create a lot of incomes and big profit, yeah, increased interest income is a good thing. Why? Because withholding tax, we need to pay maybe maximum 15% to the local and 14% to the non-resident. Or if we use DTA, double taxation agreement, we maybe get the reduction rate up to 10. So you can save a lot, right? If you pay withholding tax 15%, we save 5% tax. If we pay 14, we save tax 4%. If we pay 10, then we pay 10% on the interest payments. But you have to be able to justify why you need money. Yeah. If you cannot justify, the tax department have the right to reject the interest payment to your related party or to your shareholder. Okay, so okay, 5:30. I said today class finished early because I have another appointment, which is important. I cannot change it. Okay, so we will see each other again on Thursday. We will, run through a past year exam question about for a tax on income. So then you can test your knowledge now. Hey, if this question coming out the same level like this, what will happen to you? You're going to pass or going to fail? But okay. Okay, see you again Thursday.